Welcome to the Explainer. So, the NPP government just completely overhauled the Inland Revenue Act. And man, whether you're running a local business or just trying to manage your own personal savings, the ground beneath your feet has fundamentally shifted. We're going to cut right through the dense legal jargon today and look at exactly how these new tax laws are going to hit your wallet and your daily operations. We're talking everything from brand new tax exemptions that'll actually save you money to some seriously strict new compliance rules that could, well, cost you big time if you ignore them. Right, so skipping the legal complexities for just a second, what does this actually mean for you directly? Whether you're an everyday taxpayer, a local business owner, or an administrator dealing with payroll, this new legislation changes the whole game for how you report your money. Let's cut through the noise and give you exactly what you need to navigate this new landscape. Here's our quick roadmap for today. We'll start with the new tax landscape and what's now tax-free, then look at the rules for local businesses, withholding agent duties, the penalties for noncompliance, and finally, the bottom line.
Let's jump right into part 1. What's now tax-free? We're breaking down the new exemptions for everyday taxpayers.
Okay, here is the first major win, and it's a big one. If you're upgrading your personal ride, the profits from selling your old motor vehicle are now entirely tax-free. Under the new amendments, gains from selling your vehicle are completely excluded from your assessable income. No hidden calculations, just a clean break. This is a real game changer for anyone who used to sweat over getting hit with an unexpected tax bill just for selling their car.
And the relief actually extends beyond your garage, right over to your life insurance. The new bill provides some massive relief by explicitly making payouts tax-free in 3 very specific scenarios. Whether the payout is triggered by the death of the insured person, the natural maturity of the policy, or even if you just surrender the policy entirely, that money is yours to keep, completely free from the assessable income calculation.
Now hold on, there is an absolutely crucial point to remember here. While your standard life insurance payouts are safe, you still need to be super careful if those payouts are technically tied to your business or a pension structure. The law is very clear that if the payout counts as employment income, business income, or acts as an annuity or pension, well, this exemption does not apply. It's a very precise carve-out, so definitely make sure you know exactly how your specific policy is classified.
Moving on to part 2, rules for local businesses. Let's look at the new filing and banking requirements for business owners. Listen up, because if you own a local business, the era of cash-in-hand deductions is completely over. You absolutely cannot claim a tax deduction for a transaction anymore unless that payment is processed directly through a bank. The new rules make this crystal clear. You make a payment, but it has to be via bank deposit, bank draft, or cash deposited directly into the payee's account to successfully claim that deduction. Basically, no formal banking trail means absolutely no tax deduction when tax season rolls around. It really is that strict now.
Okay, part 3. Withholding agent duties. We're diving into the strict new procedures for administrators.
So if you're a withholding agent, handling employee taxes or unit trusts, the law now explicitly mandates that you must issue withholding certificates completely free of charge. You cannot charge the withholdee a single rupee for it. This ensures that the people you're withholding tax from have totally unrestricted, free access to the exact legal documents they need to prove their tax status. Furthermore, administrators have some new hoops to jump through. The Commissioner General is rolling out highly specific new formats for filing both quarterly and annual statements, and every withholding agent is required to adopt them immediately. As an agent, your compliance with these exact formatting procedures isn't just a suggestion, it's a strict legal requirement. You have to play exactly by the Commissioner General's new rulebook.
Which brings us to part 4, penalties for noncompliance. Let's talk about the strict cost of breaking these new rules. $200,000. That massive number represents the maximum penalty, in rupees, that a withholding agent can face for failing to comply with those new reporting formats we just talked about. It's also the exact same fine an individual can face for providing a false self-declaration to a financial institution. Now, you do get a little breathing room. The Commissioner General will issue a warning notice first, giving you 14 days to fix the issue. But if you ignore that warning, boom, the fine hits.
But it actually gets worse. 400,000 rupees is the maximum fine waiting for anyone who commits more severe tax offenses under the newly added Chapter 17A. This update fundamentally elevates the legal risk for anyone trying to dodge the system.
And these severe offenses are pretty unforgiving. We're talking about things like failing to file an annual statement, failing to file your return of income, failing to register with the Commissioner General, or outright ignoring a notice to appear.
If you get a 30-day warning to comply and you still don't take action, you trigger a summary trial before a magistrate. And the penalties? You're looking at fines up to 400,000 rupees, up to 6 months in prison, or honestly both.
Let's wrap this up with Part 5, the bottom line summarizing this new era of taxation.
So, the absolutely crucial point to take away from this explainer is that while everyday taxpayers are getting some excellent new exemptions, business owners and administrators need to urgently update their daily and quarterly habits to avoid some very aggressive new legal traps. Day 1, you can enjoy tax-free car sales and life insurance, but daily, every single business deduction must hit a bank account, quarterly, administrators must issue free certificates in the correct formats, and at year-end, you have got to file those returns accurately to avoid those new 400,000 rupee fines.
Are you prepared for the upcoming tax season under these strict new rules? You really need to take a hard look at your finances and administrative processes today, because under this updated legislation, ignorance of the rules will literally cost you. The leniency of the past is gone, replaced by mandatory bank trails and summary trials. So the ultimate question we're left with is this: will this strict new framework finally create a fair, airtight tax system, or is it just going to bury honest small businesses in administrative red tape? Let us know what you think, and thanks so much for joining me for this explainer.